Let's revise our double entry rules for inventory and just go over a few things we already know. Let's say we bought goods for cash for $700 plus $70 GST. So what journal would that go in? Because it's bought for cash, that's going to go in the cash payments journal. The source document that our business will have to prove that this happened is we'll have a check butt, and then we need to record some debits and credits in the general ledger. So in this case, stock would be a debit because it's going up. GST would be a debit because it's decreasing a liability, and lastly, cash would go down $770. What about if the business bought goods on credit for $600 plus $60 GST? Well, when we buy stock on credit, the journal that's recorded in is called the purchaser's journal. The source document, instead of a check butt, because this is a credit transaction, that'll be a purchase invoice. And then the debits and credits will be quite similar. The debits will be the exact same. Stock will go up with a debit. GST will go down with a entry there of $60 in the debit side. And lastly, the credit will be slightly different. Instead of cash going down, we'll have a liability called creditors control going up. Stock is also sold, so in this case we've sold goods costing $300 for $500 plus GST, and this sale has been made for cash. So what journal would cash sales go in? They go in the cash receipts journal. The source document our business has to prove this is a receipt, and then the debits and credits. The first set of debits and credits must record the sale amount. So in this case we've got $550 of cash, so the cash ledger is going up. And then that matches up with two credits. One's a revenue in the cash sales of $500, and one's going to increase our liability, which will be a credit into GST clearing. However, for every sale we also record a cost of sale, and that's an expense. So we'll have an expense going up called cost of sales, which will be a debit, and that'll match up with a credit to the stock control ledger. Looking at a similar transaction, in this case the goods cost $400, the sale's $900. One difference is this transaction or sale has been made on credit. So credit sales are made or recorded in the sales journal. The source document is not a cash receipt, it'll be a sales invoice. Then our debits and credits will be slightly different. Instead of cash going up as a debit, we'll have debtors control going up, in this case $990. The credits will have a matching credit in credit sales and a credit in GST clearing, so they match up with the amount in debtors control. And then cost of sales will be the same entry. We'll have a debit here of $400, and that'll lower stock and decrease stock control with a credit by $400.